Welcome to RBC's Markets in Motion podcast, recorded September 15th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know: we're introducing preliminary forecasts for the S&P 500 for 2026 of 7,100, a second half 2026 price target, and 297 full year 2026 S&P 500 EPS. We think these should be viewed as very early indications of how our models are tracking at the moment. If you'd like to hear more, here's another 5 minutes. Our main takeaway today: what our models are currently signaling for the S&P 500 in 2026. As we met with a variety of U.S. equity investors last week, ranging from hedge funds to high net worth retail, from high-level macro investors to stock pickers, and just about everything in between, it became clear to us that it's time to start talking more about 2026. When we discussed the complex cross-currents for stocks in the coming months, the conversations quickly turned to the longer-term setup. With this in mind, we've taken a look at what the 5 models we've been using for our 2025 price target are signaling for next year. As always, our 2026 price target is a quantitative exercise driven by the math. The median of the outputs of our 5 models for 2026 come out to roughly 7,100, which we are setting as our preliminary 2026 price target. Given that some of our models are based on 12-month forward returns and others are based on full-year calendar returns, we are thinking of this number as a 2H26 level for the S&P to arrive at, rather than a destination that's achieved exactly on December 31st. The range of outcomes is roughly 6,400 to 7,600. The wide range suggests to us that the forecasting environment remains more uncertain than we'd like in the year ahead. Our sentiment and cross-asset models are sending the most constructive signals. On sentiment, we leveraged the idea that the low level of net bullishness currently seen in the AAII survey has historically been a constructive signal for the stock market on a 12-month forward basis. In this instance, the latest reading, between 1 and 2 standard deviations below the long-term average, is pointing to a 15% gain in the S&P over the next 12 months, implying a second half 2026 price level of a little less than 7,600 for the index if we use Thursday's close price as a starting point. That's the most constructive model in our arsenal for 2026. On cross-asset, we rely on our earnings yield gap model, which reminds us that the S&P 500 has, on average, risen 12.7% over the next 12 months when the gap between the S&P 500's earnings yield and the 10-year Treasury yield has been in the range that it resides in today. Has the case for stocks eroded relative to bonds compared to what we've seen in the past? Yes, but not enough to suggest that the stock market should fall on a 12-month forward basis. Our earnings yield gap model would likely start to send a negative signal for stocks in terms of forward direction if the 10-year yield crosses 5%. Shifting to the economic backdrop, our GDP test that looks at how the stock market performs during 1.1 to 2% real GDP years, a range in line with the 2026 forecasts of both Consensus and RBC Economics of 1.7 and 1.4% respectively for 26 itself, points to a slightly negative return for the S&P 500 in 2026. But if we shift our attention to the economic backdrop of the following year, where Consensus anticipates 2% real GDP growth for 2027, the outlook seems a little bit brighter, as the S&P 500 moves up 8% on average in years that precede 1.1 to 2% real GDP. The fifth and final component of our 26 analysis combines the results of our S&P 500 earnings model with our trailing PE model. For full year 2026 S&P 500 EPS, we're introducing a forecast of 297, a bit below the bottom-up consensus of 305. We think it's reasonable to assume the bottom-up consensus is too high right now, as that's normally the case at this point in time. We are baking in some margin expansion for 2026, as well as an effective tax rate of around 18.5%, in line with first half 2025 levels, but better than 2024 levels. Note that our PE modeling is quant-driven, based on the relationship of the average S&P trailing PE with CPI and interest rates dating back to the 60s. To forecast their own respective outputs, both our earnings and PE models leverage RBC economics and rate strategy views on inflation, GDP, and the Fed, which they describe as a stagflation-light scenario and a terminal Fed funds rate of 3%. As our regular readers are aware, we think about price targets differently than many strategists. We view our price target as a compass, not a GPS, and as a signaling mechanism about the path that we currently see the stock market on from a variety of angles. Just like any analyst who covers the stock of an individual company, we do plan to revise our 26 forecast as new information comes to light or if our target no longer reflects our views about the trajectory that the stock market is on. The message we are trying to send with our analysis today is that the S&P 500 does appear to be on a path higher over the next 12 months and into the second half of 2026. On that note, we're also taking the opportunity today to make a modest adjustment to our year-end 2025 S&P 500 price target, nudging it up from 6250 to 6350. The main driver of this change is our updated 2025 S&P 500 EPS forecast, which we lifted from 258 to 269, or $1 below the bottom-up consensus. The EPS upgrade reflects the upside surprise in 2Q25, as well as more optimistic assumptions on margins and tax for the back half of the year. Although we are nudging our 2025 price target up a little bit and articulating one for the second half of 2026 that anticipates a move higher in the S&P 500, we do remain on guard for choppy conditions in U.S. equities between now and year-end 2025. Our main concerns have been poor seasonal pattern in September and October in recent years, as well as stalling valuations in the S&P 500, top 10 market cap names, and NASDAQ 100, the workhorses of the U.S. equity market with the best fundamentals, which have struggled of late to break through their previous valuation peaks. We are also mindful of the sudden drop in AAII net bulls that emerged in August, which, despite the positive longer-term setup that it communicates about the stock market, is a similar move to what we saw in 1Q25 and has been a leading indicator of a short-term stock market decline in recent years. There's been a lot of conversation about the support that retail investors have provided to the U.S. equity market this year, but some of the indicators we watch to gauge sentiment in that part of the market are showing signs of fatigue, such as flows to passive U.S. equity funds by retail investors, as well as Bitcoin. We're also concerned that the U.S. equity market is priced for perfection, at a time when uncertainty about the fundamental backdrop is percolating from a few angles. S&P 500 company commentary on earnings calls during the last reporting season has kept us in the camp that the real test from tariffs from a U.S. corporate profitability, inflation cost pressure, and demand perspective is coming up in 3Q and 4Q. In particular, we think there's much to learn about the state of inventory and pull-forward dynamics. And there are also questions about the health of the labor market that have been sparked by recent government and private data releases. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.